Good afternoon, everybody, and welcome back to our Cyber Trading University Closing Bell webinar series. For those of you that do not know me, my name is Josh Levitan, one of Fausto's day trading instructors here. Let me just get a quick sound check first so I know you guys can hear us loud and clear. All right, perfect. Good to see you guys back here again. Morris, George, Kyler, Grant, Leda, Amy. All right, perfect. And everybody else rolling on in. Great. Good to see everybody back here again. And like I said, welcome back. And today, guys, you're in for a real treat. Today, we have our special guest and one of our great contributors here to Cyber Trading University and our Cyber Expo series. And it's Price Headley from Big Trends. So, just to give a quick recap as far as who Price Headley is, as I'm pretty sure as you guys should already know, Price is an options trader, swing trader altogether, and he is the founder and owner of BigTrends.com, primarily as a credit spread trader. High probability, limited risk. Now, what Price will be doing with you guys today is he'll be presenting essentially his top options income trading strategy. So essentially what he's doing is he's going to show you his technical indicators to find your trades, to find the perfect options trade for you, puts, calls, debit, credit spreads, everything that there is to it. Especially the best time of the day to trade them, because essentially going into the summer, we have lower volume altogether. And regardless whether it's equities or the options trades, it's very, very limited. You have to make your money in a very limited amount of time. So that's exactly what Price is here to teach you guys today. Now, Price, are you there?
I sure am, thanks.
No problem at all. The floor is all yours.
Oh, well, thank you so much for that kind intro, and I'm excited to be with you all today. Actually, I'm on the road, but from my laptop, basically going to share this presentation with you. My associate Chris Sayre should be in to help answer questions during our hour or so together, folks. So glad to have you with us. I'll seek to come back in towards the end of the hour and also see if there's any other questions I need to pick up before we wrap up. But what we're talking about is, as was alluded to, is really focusing on how do you generate income in this market. And I'm going to share with you my number one options income strategy. And the beautiful thing about this is it really doesn't matter if it's spring, summer, or fall, or winter. Bottom line is that there's opportunities each and every week. And so I'm going to share with you how we do that in our credit spread trader program. I like to call this basically writing yourself your own paycheck in weekly options every week, that you get the opportunity to do that. Obviously, not every trade is going to win, so you've got to have a way to say, okay, how do you manage the minority of time that it doesn't win? So I don't want to suggest that there's not risk. There's always risk in all forms of trading. In fact, just quickly, just to remind you that everything we're sharing with you today is for your information only. Nothing we're talking about here should be considered a specific recommendation of buy or sell any particular investment. At Big Trends, we send out our credit spread trader email and text alerts real time when our research suggests that there's an opportunity on the bull or the bear side, or more likely both. That's what I'm going to share with you, is both the bullish and the bearish case, and also how to profit from flat, choppy markets too. As you know, the summers often give you a lot of chop. Ultimately, you know that you are solely responsible for your own investment decisions. Big Trends and the staff aren't responsible for any trades you choose to make, and not all Big Trends products or services are appropriate for all investors. We don't provide any personalized financial, tax, or legal advice. It's all sent out to every subscriber in our credit spread trader program at the same time simultaneously. Then you decide how you want to use it. And do consult your tax advisor before you make any investment that might impact your unique tax situation. So what are we going to focus on here today? There's a few things. When I poll our Big Trends coaching students, and I've mentored just countless students, that basically they're telling me they want regular income. So income is the first thought. Everybody would like some more income, right? But the bottom line is that they don't want to do it in a kind of a haphazard way. They'd like to see more consistency in their strategy, meaning a higher win rate. So obviously, when we talk credit spreads, for those who don't know what credit spreads are about, you're talking about taking in steady money, more of and if you follow baseball, instead of trying to hit home runs, you're trying to just hit singles. Just try to put the man on base, and by hitting a lot of singles and getting on base a lot, you're going to create a lot of runs, and you're going to win a lot of games that way. Same way you're going to build your portfolio, more slowly and steadily, but also managing the risk along the way. And so we're going to focus on that and how to do it every week with weekly options. Now, we're going to talk also about how we define support and resistance overhead of any given stock or market based on the Donchian channels, which is an adaptive method. It's not the one that I developed, and I've developed a lot of methods myself. But what I found here is that Donchian channels actually give us a way, if we tweak the traditional settings, to actually make this work for us every single week on both the bull and the bear side. So there's going to be something that's giving us a buying opportunity or support. There's also going to be something that's giving us an opportunity to bet that it's going to not go any further to the upside and probably come back down at resistance. So basically a bull and a bear combination opportunity every single week. And so it's all about, regardless of what you expect from any given market news. Everybody now is talking this week about Brexit. If you haven't been watching the news, if you have, you're probably tired of hearing that word Brexit, which means is Britain going to leave the European Union or not come Thursday's vote this week. And the reality is, of course, that there's the rally that happened yesterday in particular was driven off the thought that maybe Britain's going to vote to stay in the European Union. Last week's sell-off was driven on more of the fears that they would vote to leave. So the reality is you're going to see volatility each way. What we're about is looking to cash flow the opportunity each and every week with this particular strategy. Now, when we focus on that, looks like part of my screen might be getting cut off at the bottom, but that's our 800 number, 800 big trends if you need to reach us for anything. But bottom line is that this is showing you our tested results when we started doing this strategy, which is actually saying I've done credit spreads for a long time. I've done them on the S&P 500, still do. But this is actually taking a little bit more active approach to saying, look, every single week, you're not going to get one trade from us with this approach on each of these portfolios. You're going to get a bullish and a bearish trade. Basically, what we often call a put-call pair, meaning that you're pairing up our favorite neutral to bullish strategy and stock with our favorite neutral to bearish strategy. And we're going to talk about how we do this with credit spreads, because when we say a call spread on this top example, this is MasterCard. Let's look at that one for a second, how to read these. MasterCard, ticker symbol MA, back March 21st, we were recommending the fourth week of the month. So this is expiring the fourth Friday of March, selling the 93 calls and then buying the 93.5 calls. So that's called a call credit spread. We'll get into the specifics and dynamics of call and put credit spreads in a minute with a couple of charts. But when we do a call credit spread, we're essentially betting that it's not going to go past that 93 level. So literally there's a wall, we think, overhead in front of 93. If that's the case, as it was for both this neutral to bearish example with MasterCard and also the neutral to bullish example in Abercrombie and Fitch, where we were selling a 30.5 put and then buying the 30 put down below to protect it. On each of these examples, we're collecting a credit. It was $12 a contract on MasterCard. It was $10 a contract on Abercrombie. So that's taken in usually in the neighborhood of $250 or so per trade in income that you're getting up front. Now, these examples are gross money you're taking in before commissions. You need to factor your own commissions. Everybody's commissions vary, but obviously you want to make sure that your commissions are not eating up a big chunk of that $250-ish credit that you collect on each trade, give or take. So if you're paying too much in commissions, check with Chris. He can get you more details on brokers who can do this cost effectively at a fair commission, and also that give good executions, because getting in and of course getting out is even more important than just the commission rate itself. You can see there's a return that's generated on these that's usually in the neighborhood of about 25 up to maybe as high as 35% on the profit side. When we go ahead and let these positions go out at no value, which no value is good news when you're a net seller with a credit spread. All these zeros here mean you didn't have any commission on the way out. The options just literally went off the board with no value. You pocket that money. Think of it kind of like if you're the insurance company that sells insurance policies to those that want to insure their home or their car. The folks that paid a premium to insure their car and didn't have any accidents, and then the car's in great shape and the insurance policy expires, who pockets that money? The insurance company, for taking on the risk in case something had happened to that car. It's the same principle here. You're basically saying, look, we're taking on a risk factor by selling one option, say on MasterCard, the 93 call that we sell, but we're reducing that risk by buying the 93.5 call, so that we can't lose more than that half point in the worst case scenario. We're pocketing $12 a contract relative to that $50 of max risk. So actually our net max risk is about $38. We'll get into those dynamics here in a minute, but that's how we calculate the return on that max risk. Now, what we did in this example is I think very conservatively said, You could do this with about $1,000 a trade, so about $2,000 a week on the Monday portfolio, and then we also show you in a second the Wednesday portfolio because that's Wednesday one's getting even closer to expiration, so it's a touch more aggressive on the Wednesday portfolio than the Monday. Because obviously, if we do this Monday afternoon, then we only got 4 more days to go before the weekly options expire. You can see we're doing this in the very short-term options, and we'll show you why here in a minute. But we said, look, okay, you're only using a couple $1,000 of max risk capital each week, and then you do it all over again the next Monday, etc. So rinse and repeat every single Monday. Well, it's only a couple $1,000 of risk, but obviously you have risk on every position. You have risk at a couple of those in a row or more might not even work out. That's a possibility. We have to factor for that. So what we did is we said, look, let's just assume you're only putting in about 10% of your capital per trade, or a maximum of $1,000 of risk in each trade. So on a $10,000 portfolio, you can see on the right column what it grew to from the late March starting point to the late May end point. And since then, you can ask Chris for the up-to-date results because they keep on gaining on beyond this. But bottom line is that from 10,000, it would have grown your portfolio to $13,484 in gross value before commissions. So you would have to subtract commissions out of this. Obviously, past performance doesn't guarantee future results, so there's always risk in any trade. But as we'll show you with our system here, we think we've got a substantial edge that we can continue to cultivate with this combination of our technical system and the power of credit spreads combined. So you can see a lot of the times we might do a half-point spread, but sometimes we might do a full-point spread. That would differentiate why the contracts say, look over here on Facebook, for example, a few weeks later, you can see Facebook FB, it's a higher dollar stock now, right? 110, 109 put credit spread. That we were net bullish, neutral to bullish there. And so on that full point spread, we collected $20 a contract. That meant that we were risking that full point minus that 20 cents, or $80 a contract of max risk. That one expired. We pocketed $20 on our AD risk, or 25% return on that maximum risk, what's also called your margin requirement. So you can see that, yes, occasionally there will be losing trades. You can see in this example we had looks like 4 losers over that period, including a 50% loser. That's usually our maximum cutoff in that neighborhood for the Monday trades, and we want to manage accordingly. Let's look at Wednesday for a second. So the Wednesday trades, we initiated that portfolio right at the end of March. And you can see now, again, in this example where we're looking to take about that 25 to 35% maximum profit. What happens here is with Wednesday afternoon trades, with only about a full 2 days left before these options are going to expire, we have to go a little bit closer to the money. I'm confident doing that because we're buying right near support, and essentially we're bullish near support, I should say, doing the put credit spread as a net seller of one put and then buying a cheaper put. And then, of course, if it goes against us, we got to pull the plug when it hits down around minus 50. You can see a couple of these slip to minus 56 and minus 53. But we don't want to just hold and hope and get ourselves into a minus 100 position. It can happen, but the bottom line is that if that happens, then you've got about another 3 to 4 trades of work. You've got 3 to 4 winning trades you've got to pull out to make up for a 100% loser. Obviously, if you can lose somewhere around 35%, you can make that up in 1 or 2 trades. If you lose 50% or so, you're probably going to take a couple trades to make that up. So our objective here is to obviously limit those times where that happens. And so bottom line is that, yes, why am I talking so much about losers? Because that's where most credit spread trading services and credit spread traders go wrong. They basically just say, well, it's going to gradually work for me over time if I just give it a chance. Well, you know what? Sometimes the trend breaks down. You don't need to hang around. You need to say, I'll exit first and ask questions later. Okay, but you can see that portfolio still grew from $10,000 up to $12,625. for over $2,600 in gross profits. So you can factor your commissions accordingly. And like I say, when you add the two up, remember $2,600 there, the other one was what, over $3,400. That's over $6,000 in profits if you're trading both the Monday and the Wednesday portfolios from late March into late May. And since then, of course, we've had success in the last few weeks as well. I just am operating off my laptop, so I've got those prior slides. Call Chris at our 800 Big Trends number to see the updated closed trades as well, because it keeps thus far keeps on growing. We're confident we can keep growing this way. Why am I so confident in this strategy as a vehicle to steadily grow your wealth? Well, because you got a lot of scenarios where you can make the trade work for you, even when you're wrong on the underlying stock. Okay, you just don't want to be wrong in a big way. I can be wrong small, even medium, and not get hurt. It's where I'm wrong big that if you don't cut and run when it's starting to unravel against you, that's where you can get yourself in trouble. So in this example, let's talk about risk as well as reward. Stock's at 47 bucks. You think it's going higher or certainly not going down below 45. So the stock's here on this red hash mark about where the green arrow is at 47. Now, what we do in this example, let's say if we're betting that it's going to stay above 45, you sell the 45 put, but simultaneously you've also got to buy another option to protect yourself. See, if you just sold the 45 put, that would be called a naked option. And we don't want to be naked in the options. What that means is that you're going to get more premium by just selling the 45 put, but you're going to be taking on the theoretical risk that thing, if it came out and said the company's worthless and it goes to nothing overnight, you'd have 45 points of risk, right, from 45 down to 0. So the thought becomes, when you sell a 45 put, essentially what you're saying is, I'm willing to buy the stock at $45. Now, we're not going to buy any stock or sell any stock here. We're looking to, just focus on if we need to close the options out before we hit the expiration or right into the expiration, we will, to avoid acquiring any stock, bullish or bearish. We're talking about, though, you don't want to be on the line if the stock starts to take a big dive. And you can see in this case, look, at 45, if you just drew a dotted line there, at the expiration at 45 or higher, you're making your money, in this case, 200 bucks of gross profit against the 300 bucks of max risk you had. How is it 300 bucks max risk? It looks like a 5-point risk, right? 45 down to 40. Below 40, of course, you're capped. You can't lose more than that 5-point differential, but you took in 2 points or $200 a contract. So you put up 500 minus your 200 or 300 bucks of max risk. That's how your margin requirement or max risk is calculated. Obviously, above 45, that's a very large 67% return on margin. We're a little more conservative than that in our credit spread trader, where we're going to take in a little bit less premium, but we're going to give ourselves even more breathing room in the final week of an option's life. You can see in this example, look at that. At $43 is your break even at expiration. You started at 47. I made my full profit 45. If it goes down to 44, I'm still making money. At 43 at expiration, I'm breaking even. Why? Because you pocketed that 2 points. Well, 2 points underneath $45 means you're breaking even, again, before commissions, at 43 bucks. Now, what this means is that that's giving you about, 8.5% being wrong and still breaking even at expiration. About 4 and change percent you can be wrong and still make your maximum profit. I don't know about you, but there's something that feels just really, really good about being wrong even by a small to moderate amount and still getting paid. And so, of course, if you thought a stock was going to go up, most of you are used to buying a call. And what we're saying here is, you know what, instead of doing that, if you sell the out of the money put, a couple points out of the money in this example, buy the other one to protect yourself as insurance. You now have added 3 different scenarios where you can get paid. Of course, if it goes up like you thought, you're going to get paid with the credit spread. If it stays flat, you're going to get paid, which you wouldn't get paid if you bought the call. And if it goes down a couple of points, you still get your maximum profit. So you're giving yourself a wide range of scenarios. That's why the winning percentage with the credit spread, especially if you do them right this way, using the out of the money options, is going to give you, a lot of scenarios where you can get paid. And cash that weekly paycheck. So the idea here is that your goal, of course, in the strategy is you do not want the stock to move dramatically against you. So if you're really wrong, you got to have a parachute to pull the ripcord and get out of that trade when we see that, okay, that support's not holding anymore. We have no excuse, no reason to be in the trade, so no excuse to hang on. Let's get out and let's move on. Take that first lump before it turns into something worse. Like I said, those losing trades, it's just about containing the damage. About somewhere in the neighborhood of 20 or 25% of the time is our expectation on where we're going to have a trade where we need to cut and run early. So that insurance also gives you a lot of confidence that you can sleep well at night knowing you've protected your max risk. Now let's go on to the neutral to bearish example. So in this case, you're usually thinking about buy a put, right? You've heard about put protection. Well, you know what? We're doing something different here. Stock's about 33.5 in this example. And you're saying, look, I think it's not going over 35 bucks. So we sell the 35 call, but at the same time, simultaneously, we're buying the 40 call to protect ourselves. So you just think about the math there. You can see in this example at 35 or less, you're seeing that you're making your max profit. So the stock can go up about $1.50 off of 33.5. That's pushing towards the almost 5% range there, and you're 5% wrong. You're still making your maximum profit in this chart. If you're down to $37 as your break even, you can see in this case $37 from 33.5. You're wrong by just over 10%, and you break even. That still feels pretty good. If you hit that point at expiration and you say, okay, fine, I was clearly not right, but I didn't get hurt. And you get hurt, of course, if it moves more than 10% against you. But that's a lot of different scenarios that can work for you. So again, same goal. Let's control the risk. If it's going to move dramatically up, then let's make sure we're not in that situation. So one example where I would be concerned is if there's takeover rumors on a stock. If you think a stock's got a takeover possibility floating around, you don't want to be doing call credit spreads because you might walk in the next morning and it was at 33.5 and now it's at 40 plus. So, that's something we want to try to avoid is any kind of takeover related names. I also don't want to do the strategy right in front of an earnings report. So those are a couple of critical times not to do a credit spread. And as we mentioned also, where we like to do these trades is in the final week of an options life, and especially as I promised you to talk about when during the day do I like to do these. I like to do these in the last couple of hours before the market closes, because you're really positioning for, okay, what's likely to happen as we come into the next open and the next few days of opens on a Monday setup or on the Wednesday setup. Only two more opens you have to deal with before you hit the Friday expiration. Now, why do I love weekly options so much? In the final, we're less of an options life. You can see on this time value chart, this is also called how to make Theta your friend. Now, Theta is an options Greek for those who follow the various option Greeks like Delta, Gamma, Theta, and Vega. Theta is the time portion of the trade. T for Theta, T for time. That's how it's easy to remember. That the bottom line is that what we're talking about here is that you see that time decay, that how much the premium falls off. We're just talking about the time portion of the trade with about 4 months ago or 120 days out. You can actually see I wouldn't really want to sell a 4-month option and try to hold that for a month or even a week because you can see there's just not much of a fall off into time value. So obviously option buyers might be more prone if you didn't have an edge in how you trade options. You'd probably want to buy more time to really reduce your theta risk. But really, when you get into selling an option, the last 30 days life, you can see is roughly here about almost 2/3 of the options value in the last 30 days is going bye-bye in the time portion of the trade. Well, I can take that a little further and say, you know what if you looked in about the last 7 days of the options life, the last week of the options life or less? Look at how much of the trade falls off there. It's roughly about 30% of the options life here. If you just drew a new line across here, it's between a quarter and 30% of that option time value-wise goes away in the last week of its life. How is that possible? A way that I like to make people think about this is really encourage you to say, look, if you just held an option for one day, if you're going to hold it for one day and you did the 4-month option at 120 days from expiration, hold it for one day. That's less than 1% of that option's life. That's why that thing is not falling off at all in those first 30 days on this chart on the left side. But you can see if you held an option, say on the last day of expiration, say you got 1 day left over here, and you hold it for a day, guess what? You just lost 100% of the remaining life of that option with that 1 day hold on the final expiration day. If you hold it out there, say 2 days to go, you hold it for a day, you've lost half of the options life. So it's a geometrically accelerating time erosion on a day-by-day basis as you get closer to expiration. So we're profiting from that by actually selling that premium and letting that melting ice cube of time melt even faster to our favor in the final week of the options life. So with the credit spread trader program that we offer, weekly options give you a lot more opportunities than if you're using, say, monthly options. Back in the 90s, I got started trading in 1990, fresh out of graduating from Duke University, and thought, wow, you get a couple of quick scores, you think, wow, trading seems really easy. And you pay the price with a couple of trades that don't go your way, and you kind of go look at exactly what's going to give you the best risk and reward relationship. To me, credit spreads done properly really give you a tremendous opportunity to generate steady income, but they also have to be managed properly so that you're not just randomly putting the trades on. So we want to talk about our adaptive bands with the Donchian channel approach that our system tests show gives us such a big edge in this particular approach. And the other nice thing is that now with weeklies, by the way, we're getting In the Monday portfolio, that's 2 trades a week, 4 weeks in a month typically. It's 8 trades a month if you just trade the Monday portfolio. If you're doing the Monday and our Wednesday portfolio, that's 4 trades a week or 16 trades a month. And the beauty of this is that you're not holding more than that 2 to 4 trades each week. They go off the board or we shut them down if we have to, and then we move on, and we got another 2 to 4 trades depending on if you have one or both portfolios. So the bottom line is that you're not doing too many trades at once. You're just taking advantage of what the market gives us week after week. Another beauty of that is that you're turning the markets into a cash flow machine, and you're not stuck just buying the market and holding and hoping. A lot of different opinions about what's going to happen with Brexit, what's going to happen with our presidential election, how that's going to affect the market. The bottom line is this system says don't worry about that. It says get to work, start cash flowing this week, next week, and in weeks going forward, and let the system take care of that day-to-day volatility and actually profit from it. Now, we take a lot of the major stocks. There's a list of really a couple hundred key stocks that we watch out of more than 4,000 plus optional stocks out there these days. So we're really talking about the top few percent that we really want to focus there for our credit spread trades. So that's going to be where the liquidity, the activity is. It allows us to really focus in on the best of the best type of situations. Now, some quick guidelines. Like I said, on the Wednesday portfolio, we're really only get 2 full calendar days plus maybe another hour or 2 in that Wednesday afternoon entry. In fact, we'll have 2 more new trades for Wednesday traders tomorrow afternoon. And then if you're doing the Monday trades as well, those are going to come in on Monday afternoon, the last couple hours of trading. So 4 more calendar days to go, barring any Friday holidays. And then basically you just take advantage of that week after week. Like I said, 8 to 16 trades a month. And the key here is these are out of the money options on both sides. We're doing a call and a put. The other key, of course, is that we're making sure that we're doing this on the put and the call together. So basically we're not taking, say, market risk. We're really trying to let our stock picking tell us which stock should hold its support and which other stocks should pop back down after hitting resistance. 25 to 35% max gain on risk is our sweet spot, because we find if you start getting greedy and shooting for that bigger return on risk, you're going to probably get whipsawed in some trades, especially with this market volatility. And so if we're doing a 1-point strike, we're usually going to have somewhere in the neighborhood of about $75 per spread contract as our max risk. If we're doing half-point strikes, we're going to probably be looking at more like $35 to $40 per spread contract at max risk. So you can decide what's your right kind of risk to take per trade that fits your own particular portfolio and risk profile. Now, as I said before, we don't want to get cushion. You think of a cushion, I like the example there where basically you're thinking about, hey, if the air gets taken out of that raft and you're floating on that raft in a nice little afternoon in the pool, well, you know what? You're going to be in the pool if that raft loses air. If you lose your safety zone or margin of error, the cushion goes away. The air gets taken out. You get too close to the water and you risk sinking, right? Or getting wet at least. Bottom line is that our objective here is to say let's focus on making sure we have a nice cushion that maintain that cushion. That's why it's important to us, even though we're trading basically a strategy where we can still be wrong and get paid. We still want to put the trades on where we think that a stock can bounce on a put credit spread and give us even more of a safety zone or cushion, or likewise at resistance, a stock after we put the trade on can come down, and that gives you just that much more breathing room to allow you to give the trade as it's designed the opportunity to expire worthless. This is where you're happy when those trades expire worthless. You pocket that premium, no commission on the back end when the trade goes away with no value. And they just literally get wiped out of the account and you just pocket that money. It's a beautiful thing to watch over the weekend, to watch them go away if you haven't traded credit spreads yet, and say, okay, then let's just ready to do it all again Monday afternoon and Wednesday afternoon next week. So now a few key technical rules. We'll look at a couple examples here. Bottom line is that, okay, we're looking at a 7-day range of recent prices. Okay, so we're really not worried about what happened even earlier this year, or frankly, more than about a week and a half ago. Because basically now, of course, everybody's focused on Brexit. You had the sell-off last week, now it's early this week. Now it's like, okay, what is the market telling us about the likely trading range of prices for not just the overall S&P or NASDAQ, but we're talking about now looking at individual stocks and how they're trading. Now, one of the things that we want to see when we talk about Donchian channels, Donchians are looking at that 7-day range, the highest high and the lowest low over the last 7 days. What we're talking about here is that for a bullish candidate, it's got to be above the longer term moving average, in this case, a 200-day simple average. And then we're looking for stocks that are in the bottom quartile, the bottom 25%, basically close to that lower support band, and not sort of stuck in the middle of that range. So this is going to give you an opportunity to put the risk reward in your favor. Likewise, for the net bearish candidates, where we're looking at a call credit spread, we want to be in the top 25% of their recent range, and it needs to be below the long-term trend line. So it's kind of like this. It's like you want to buy quality stocks in a dip, right? But the key is how much of a dip is too much. If it's dipping and still above the 200-day, that's a healthy thing. You buy dips within the long-term uptrend. But if it's broken down below that longer-term trend line, you want to sell bounces at that point, and that's where the bearish candidates come in. They've got to be trading more than 1 million shares. And like I said, the number one requirement for us is this pair trading hedge, that you're getting a net bullish and a net bearish opportunity. And you know what? If they both just chop around and go sideways, we've added in the neutral scenario as well, profiting for us, as well as even going slightly against us in both cases and still getting paid. So, the key is we look at each stock relative to its historical performance going back many, many years, and it needs to show a positive overall equity curve. And it didn't just happen off of a couple of examples, but it gave you a very consistent profile. Now, let's look at a couple of the charts about how we generate income using these indicators like the Donchian channel. So here's an example from the end of April where we had, every week it's going to look like this, where we've got one put credit spread. In this case, it was on Merck. And so we'll show you, actually we've got Wells Fargo to start. Wells Fargo was the call credit spread, neutral to bearish on WFC, the big bank stock. Now you can see here, the first circle is where we actually entered this trade. So we're entering the trade here. And here's an example where initially for about a day and a half or 2 days, we're wrong. It's bouncing initially here. And again, we didn't panic. That purple line is the strike price where we sold the option there at $51. So we sold the 51 call. We bought the 51.5 to protect ourselves. Now you say, oh, well, intraday, it's going above there, but look at what happens. By the close, it finishes back below. There's all kinds of fake outs that are happening during trading days. It's very important to us that you don't overreact, but rather that you focus on, who's winning the war on a day-by-day basis. So, again, it came close to testing us, but it basically then flipped back down, and then you see by the expiration day, it's way back down. Anything under 51 is fine, and this one finished just around or just under $50. We pocket that $250 on the Wells Fargo example. Now, on the other side, if you looked at we were neutral to bullish on Merck, MRK, you can see here's where we entered. You saw we were hovering near, not at, but near the bottom support. And you can see for a couple days after that, we're still hovering and holding that support. But on that Thursday, right before expiration, you see where things start to break down. We actually close below that support line that we thought was right in the neighborhood of about 55.5. Well, you can see we had sold the 55.5 put. As it starts to go against us there, we say, hey, let's not hold in hope here. Let's go ahead and say bye-bye to this trade with a day left. We had to buy it back for $12 a contract versus the $10 we collected. So we actually lost 5% against our margin that we had to put up to cover the worst case scenario. You can see it's a good thing that we did, because I'll put an X where what would have happened is you would have seen a total wipeout the next day. So people that don't follow the rules can get themselves in trouble if you hold in hope. So in this case, of course, it closed below $55. That was your worst case risk. Those that held on and didn't follow our exit instructions would be risking 100% loss. And if you're afraid of missing these entry and, more importantly, these exit signals, this portfolio can be auto traded, where you can have brokers automatically get you in and out based on our research recommendations when we send them out real time to get in and, more importantly, to get out. So that's something you can check with Chris on about auto trading. Now, one of the important things to me is just give you a sample of the kind of, just looking at the overall market. We do this on all the individual stocks. And this is what I call a curve. This actually shows what your portfolio would do using the system in the S&P 500, just to give you an example. Going back in this example to 1993. Okay, now this is showing you a lot of history, right? Some 23 years worth of history. The green dots represent where you're making new equity highs. And so you can see over 23 years, you've had about 230 trades. That's about 10 trades a year on the nose. Okay, so obviously we don't just want to do this on S&P. If we're looking to do 2 trades a week over 52 weeks, that's going to give us more than 100 trades. Well, the way that we can do that is by looking at the individual stocks, because we're going to get a lot more opportunities in the individual stocks than we will in the S&P. There's still opportunities for S&P traders. We do that as well, but bottom line is for credit spread trader portfolios, we're really focused on the bull and the bear every week on the equity side. That's how we hedge market risk. So you can see that we're going to get that kind of profile, and when we run the data to show, okay, how much on bullish or how much on bearish trades you would have made. In this example, about 3/4 of profit came from the bull side of the equation, but you still made money on the bear side as well. So that's encouraging. We also look at numbers like, okay, what was your overall win rate on the S&P? 83%, and that's just on the SPY. If you're buying and selling SPY, that doesn't even count when you overlay a credit spread strategy on top of that. It's going to further enhance your results. Now, if we're doing a little bit of an analysis on what I showed you at the beginning, the Monday and Wednesday portfolios, you can see the Monday portfolios, again, past performance is not a guarantee of future performance, and you need to factor your commissions in. These examples are gross results before commissions, okay? So factor your own commission against that and subtract that commission back out. But bottom line is that you get our actual winning percentage for Mondays coming into our launch to the bigger trading committee was right at 80%. We're usually expecting between 70 and 80. 70 is still going to give you a nice overall profile typically, but obviously we'd like it to be 80% plus. 8 out of 10, it sure is nice to be able to achieve that, and we expect that we can be in that range over time. But we don't have to be. We can still be below that and still make money. The key is you got to manage your losers. You cannot let your losers run out to 100% losses. You got to be able to cut and run promptly when they start to break down. 25% profit on max risk is our usual target. We were running almost 28% on average through that window. These were in the Monday portfolio 4 full calendar days plus maybe another hour and change on average. But we got out a couple early, so right at that. And then you add up all the winners and losers, and it's plus 348% cumulative, going back to actually 4 June. Through this period. Now, and you can, like I said, you can call our 800 big trends line, get the updated results, including our most recent June close trades as well if you want to. We're happy to update you with all closed trades. We don't share open positions. But bottom line is, you can see the Wednesday results surprisingly were even higher win percentage in the test period, 83.33%. Again, we would expect maybe even a hair less winning percentage usually on Wednesdays because you have to trade them a little closer. So we might have to cut and run on those a little quicker sometimes if that happens, and when it happens. It will happen. I promise you. There will be trades where we got to cut and run before the expiration, but our average net gain for that period was 27.2%. And again, that's over just a couple of calendar days. Obviously, if you took an average profit per day, the Wednesday is going to end up looking even better than the Monday. But of course, Monday gave you a little bit more total profit because you're taking a little bit more premium on Mondays than Wednesdays. Cumulative gain on the Wednesdays was 262% to the good. Again, gross profits before commissions. Now, what we set up here actually is 2 great values in my opinion. There's a great way to set the Monday trades only. You want to just get started with the next 30 days access, so the next 1 month access. So you get basically the next 4 weeks. You're going to get 8 trades per monthly period, and basically you can try the Monday portfolio for the next month for just $69, and you can let that keep going into perpetuity if you like, basically, and you'd lock that in at a real nice value. What I've done also, though, for even the best value is saying, if you want to get the Monday and the Wednesdays, instead of taking 69 times 2, pushing it to $138, I'm going to give you the opportunity to get both the Monday and the Wednesday portfolios on next 30 days. Try it, and if you like it, I'll let you keep going at just $99 a month. So basically, think about that. If you do the $69 gets you 8 trades over the next 30 days. Guaranteed. If you want 16 trades over the next 30 days with the Monday and Wednesday combined, you're getting that for just $99. That's getting your cost per trade down just over the $6 per trade range, right? So, bottom line is that both of them offer you great value. And what we've done is we set it up for you at bigtrends.com/credit spreads. So actually, you can really take advantage of this. Let me actually show you that real quick on that page, what that looks like, and then I'll come back in and see if I can answer some questions for folks. But basically, when you go over to that page that we set up for you here at bigtrends.com/credit spread trader, actually, you'll see here that we actually give you this. Usually we sell these because we've had a big launch. Our Big Trends crowd actually, as Fosso has been really good to me. I wanted to get you all an opportunity to get started. Just try it for a month because you might not be as familiar as all of my big trenders are with how we do things at Big Trends. I started Big Trends, by the way, back in 1999. I was actually telling people who were day traders only. I know Fosso is a big day trader, one of the original day traders out there from the late 80s and early 90s, and it does a great job. But I was telling people, look, there's a lot of opportunity past just a one day at a time look. So, one of the things I think a lot of people get burned on is not knowing how to follow a systematic approach to when they need to not just get in, but more importantly, get out. So that's what we offer you at Big Trends, is a much more systematized portfolio. So like I said, the Monday, we're doing the put and call credit spreads together. We're doing the same thing on Wednesdays. So the Monday starting point, though, is what you're getting for just opportunity here for just $69. If you just want to do the $69 offer, you just click this text below. Now, these are auto renew, so you need to tell us in the first 30 days if it's not for you for some reason. I'm highly confident if we continue the trend that we've been in, that you're going to be very excited to let it keep going month over month, because if you're trading it, you should be with those kind of results paying for that many times over. Now, bottom line though, again, past performance doesn't guarantee future results. We all know that, but I'm confident even if our winning percentage dips a little bit, we still should be showing a very good risk reward profile on all the trades combined. Now, this is also encouraging you to say, look, don't pick and choose. If you want to follow the system properly, you should take all the trades and not just try to pick the ones that you think are make more sense on your existing system. That's something I see with if you're gonna pick and choose, some people can get themselves in a spot where they missed some of the winners and ended up with a loser or two that they didn't have the winners to offset. So basically, again, this is assuming you follow the portfolio approach over all the trades. Again, we send them out real time Monday afternoons, and then if you have both the Monday and Wednesday afternoons as well, usually between 1 and 2 hours before the market closes. So we give you enough time to really take advantage of this. We promise them by 3 p.m. if not before. So not really earlier than 2 p.m. Eastern, Wall Street time. So you've got between 1 and 2 hours to operate and get that trade filled. Like I said, if you're working a day job where that's not a possibility for you to be aware of the markets real time, you should definitely check with Chris, my lead consultant, on the auto trading. So Chris there can get you more details on that. But like I said, the auto renew means that basically if you don't tell us anything, we're going to assume you're happy, and in 30 days, it just keeps it easier for everybody. You don't have to constantly keep calling us with a credit card. We don't have to keep chasing you down for a credit card. You say, okay, look, we assume you're happy unless you tell us otherwise. If you're not, I kind of want to know why, because I'm pretty confident you're going to be very happy with this approach here. Now, bottom line is that you'll see when you want to add both, all you have to do is just hit the add to cart button. Before I do that, though, let me just remind you a couple of the other nice features you get as part of this. It's not just a black box system, okay? I'm going to give you a weekly video every single Monday morning that's going to recap, whether you're the Monday or the Monday, Wednesday combined, it's going to recap what happened last Monday and Wednesday on the trades by Friday's close, win, lose, or draw. So, I cover all trades. I cover what's working, what's not working, where I think the market's headed in the week ahead, and how we're positioning. We call this a learn while you earn approach. See, I put a big value on education at Big Trends, and that's, I think, what's really set us apart and allowed us to be around since '99 and going strong, based on really making sure that you understand what's happening underneath the trade alerts that go out that show you, okay, yes, you're going to get trade alerts that say, yeah, we're selling to open this credit spread on, like in these examples here, Yahoo, selling the 35 and the half put, buying the 35 put. Okay, that ended up being a 28% return on risk. Visa, and this is one that you can see. Again, remember, put spread is neutral to bullish, so it just flips around what you're used to if you've been just buying options, right? Instead of buying a call, you're selling a put and then buying a cheaper put. You are net collecting money in up front. So then it's basically, you're just saying, okay, we're collecting that premium. Your job is to hang on to that premium. That's our job, to help you hang on to that premium, let the options go out worthless in the majority of cases, and then look to do it all again the next Monday and or Wednesday. Now, you can see you also get unlimited email access to my research team and myself. If you've got questions about the trades, about what we're doing. We can recap what we're sharing with subscribers. Again, we don't give anything personalized. If you've got some other position on, we don't do that. We're monitoring these positions that we recommended for our entire subscriber base, and then we're giving these video updates to kind of recap what we're doing. We're also giving you real-time follow-up emails. So if you're wondering on a Friday, well, what do I do with these positions? Are they going to be safe or are they not? We send out a recap on Fridays as well, telling you, hey, everything's safe. Let the options go off the board. No action needed. Or, you know what, we're watching this one. It's close enough that we may have to close it out early. Stay alert in the final hour or two. We'll send you instructions as needed where to get out. So you're going to get that kind of real-time monitoring each and every day and week. So throughout the entire next month and year, of course, this is a monthly offer, but we're going to be monitoring this out the coming years. So basically, day in and day out, so you know what we're looking at. And where, you need to pay attention that, hey, we might have an exit, because we don't want you missing an exit. And like I said, if you're concerned about missing an entry opportunity, or more importantly, an exit to shut down a position if we need to, that's where you should ask Chris about the auto trading feature, because that's something where our auto traders don't charge any more than what you would pay if you use their platform yourself. And the bottom line is that then you can really know that you've got that extra set of eyes watching for you and executing, more importantly, for you when it's time to get in, or more importantly, time to get out. Okay, so bottom line is, if you just want to do the Monday only, just click on the blue text down below the add to cart button. Just left click on that. Or the best special, like I showed you, is the month of both the Monday and the Wednesday combined, just 99 bucks for every 30-day period. So you can see it actually defaults you, even when you click on that add to cart, to just the Monday only $69 option. To add the Wednesday combined with Monday together, just click on that yes, give me the month auto renew of the Wednesday as well to go with the Monday, and that's 99 bucks. No taxes if you're not in the state of Kentucky, where I am, and no shipping, because we're getting it to you through real-time email alerts. You also get members access, where you'll be ready to roll. Just quickly walk you through the checkout process, and I'll come in and answer a few questions before we wrap up here. I know Chris has been helping me to answer questions. I hope he was able to make it in okay there. Bottom line is that once you hit the checkout button in green there, you get the bolded fields where you just need to put in your information to go ahead and get it ready for, make sure you get your email right in there, so we ask you to confirm that. And then your billing information for any of the major credit cards, Visa, MasterCard, Amex, Discover. And what you'll also see down below, I know Chris has been in, I hope he's helped you to get started. If he has, give him credit on the who assists you with the order. But this customer note field, I want you to take a special note of, because if you'd like to get text alerts, here's what I'd like you to do. At no additional charge from us, you should have unlimited texting on your smartphone to do this, because we'll send you plenty of texts to back up the real-time emails. You'll also get real-time texts if you want to your smartphone. No additional charge from us. Just make sure you've got from your cell phone provider unlimited texting. Bottom line is that you just say text alerts to this whatever number it is, whatever your smartphone you want to get them onto. And then we do ask that you tell us which provider you use. If it's AT&T or Verizon or Sprint or you name it, etc., type in whichever one it is, because we do put each of those in specific batch files. So when we hit the send button, it goes to each of those batch files simultaneously, so that it's going at absolute fastest and not getting hung up. All you do then is review the terms and conditions, which are spelled out down below. We even break it out here too, just so you know how the auto renew programs work, and how we do things. So if you needed to cancel it, if you needed to turn it off for any time, if you weren't happy for any reason, you can avoid future billings by just reviewing that and notifying us through any of the notification methods shown there. So we're all about full transparencies. You know how we do business. Like I said, been doing business now for 17 years. Started the company in '99, looking to do it for another 17 plus, God willing. So bottom line, it's a great thing to be able to share the things I've learned over 25 plus years of trading with you, and do it at a very fair rate so you can get started. And then the onus is on me and my team to make sure we show you that we're adding value for you well over and above that $99 a month subscription fee. So bottom line, you see cancellation policies, everything spelled out there, and then the full terms and conditions are spelled out through that link here. So we're very transparent. Now let me go in real quick. I want to see if I've missed some other key questions here before we wrap it up. So what I'll do here real quick is I'll just pop up in the webinar room and see what other questions I might have missed here. So, if you're at work, yes, Dave, you can do the auto trade. That's no problem at all. We're here to help on that. Um, uh, let's see. Do we offer other option services, Ray says, besides credit spreads? Of course. We do straight buying. We do debit spreads. We do a variety of things. We do an earnings-based strategy with earnings coming up. Check in with Chris at our 800 Big Trends line. He can walk you through all that as well. Do you learn how to pick strike prices, John T says? I can assure you they're going to be out of the money. We'll walk you through why we chose different support levels and resistance levels. So that's no problem there. Yes, we showed you the actual trades that we were calling out in real time there, and you can get all that updated through June there as well. So we're here to help, okay? So that's how it works there. Looks like that's all the questions for now. So basically what I'll do is I'll hand it over to Josh and the cyber trading team, but I just want to remind you again, if you want to get that special, Chris can repost the link in there for you at the bigtrends.com/credit spread trader link. And also you can call us anytime through our 800 Big Trends number. That's 1-800-244-8736. But I always just tell people, look, if you can't remember, it's 800 Big Trends. It's bigtrends.com is the company I founded in '99, and Chris has been a valued member of our team now for almost 5 years. And so bottom line is that he really understands the ins and outs of how to get you set up. If you've got questions about auto trading, questions about the mechanics of the service, you need to see a sample past trade, anything like that, check in with him through the 800 Big Trends number, or he can also have you contact him through our email, clientcare@bigtrends.com. So remember, just on this special, I'll pop it up one more time so you can see it here, where to go. Go to bigtrends.com/credit spread trader, and you'll be able to manage of our rare opportunity to lock it in just a month at a time. We're making it really accessible for you, and it's because I have such a high confidence level in the value of what we do, and also, frankly, in the winning percentage that we've been able to generate through credit spreads over time. That we keep that winning percentage up. That's on us to do that. Then you're going to be very motivated to want to keep getting that kind of quality of trades and that kind of consistency with steady weekly income opportunities with our credit spread trader program. So any questions you have on that page, by the way, you can just go to the top right and you'll see our 800 number. If you forget it, it's up there in the top right, or just remember 800 Big Trends, as well as our email, clientcare@bigtrends.com. So check it out, folks. Really want to say thanks to all the cyber trader team. They always do a great job, and it's always a pleasure to work with them. They put the same kind of value in giving you a quality trading education. So check that out. If you have any questions, give us a call or drop us a line. We're here to help. Wish you great trading, taking advantage of not just Brexit this week, but also what's to come through the summer, through the presidential election in the fall, and headed into 2017 as well. I think there's going to be a lot of opportunities on both sides. We're going to be positioned to take advantage of both bull and bear opportunities, as well as choppy markets week in and week out. So definitely thanks for being with us. Check that special page out we set up for you, and I'll hand it back over to Josh and his team now. Take care, everybody.